The year 2025 began with a collective shudder across Wall Street. The seemingly invincible bull market, which had charged forward for years, stumbled and fell. This wasn't a minor dip or a quick correction, this was a full-blown crash, leaving investors bewildered and portfolios bruised. Understanding exactly what happened is crucial. It's about more than just analyzing the past. It's about learning how to protect ourselves in the future. We need to dissect the warning signs, the hidden cracks in the foundation that led to this dramatic collapse. This crash wasn't some unforeseeable black swan event. The signs were there, whispers of instability amidst the roar of the bull market. Our job now is to understand these signs, to become more informed and savvy investors. Remember, every crash, as painful as it is, offers valuable lessons. Let's learn from the wreckage of 2025. The crash wasn't the result of a single catastrophe, but rather a confluence of factors, each one amplifying the others. Think of it as a perfect storm brewing in the financial markets. First, earnings pressure became a major headwind. Companies, accustomed to delivering stellar growth numbers, started showing signs of strain. This led to missed earnings targets and a wave of disappointing forecasts. Adding fuel to the fire were geopolitical tensions. Global conflicts and trade wars created a climate of uncertainty, making investors skittish. Trade disputes in particular disrupted global supply chains, impacting corporate profits and further fueling the anxiety. Then there was the delayed reaction to the Federal Reserve's rate hikes. While the Fed had been gradually raising rates, the market seemed almost impervious to their actions, until it wasn't. This delayed impact created a whipsaw effect, adding to the volatility. Looking back, the economic dashboard was flashing warning signals well before the crash. Growth, once robust, began to sputter. The Citi Economic Surprise Index, a key gauge of economic momentum, started to trend downwards. This index compares actual economic data releases to economist forecasts. A declining index signaled that the economic engine was losing steam. The bond market, often seen as a leading indicator, also hinted at trouble. The yield on the 10-year Treasury note, a benchmark for borrowing costs, began to flatten. This flattening yield curve is often seen as a precursor to economic slowdowns. Adding to the gloom, the U.S. Financial Conditions Index, a measure of stress in the financial system, began to deteriorate. This suggested tightening financial conditions, potentially choking off business investment and consumer spending. Section 4. Sentiment shifts, from euphoria to fear. Perhaps the most dramatic shift leading up to the crash was the change in sentiment. For years the market had been driven by unbridled optimism. Investors poured money into stocks, fueled by a fear of missing out, or FOMO. This euphoria led to inflated asset prices, particularly in the tech sector. Valuations became detached from fundamentals, setting the stage for a painful correction. As reality set in, that euphoria quickly evaporated. The realization that valuations were unsustainable, coupled with growing economic concerns, triggered a mass exodus from risk assets. The fear that had been absent for so long came roaring back, pushing investors to sell first and ask questions later. This panic selling only intensified the downward spiral, turning a correction into a full-blown crash. Section 5. Navigating the storm investment strategies for volatility. So, where do we go from here? How do we navigate a market prone to such dramatic swings? First, we need to acknowledge that volatility is the new normal. The days of predictable, steady growth may be behind us. This means adopting a more defensive posture. Diversification, once a recommended practice, is now essential. Don't put all your eggs in one basket, especially a basket woven from high-flying tech stocks. Second, we need to become more discerning investors. Instead of chasing the latest trends, we need to focus on companies with strong fundamentals, solid earnings, reasonable valuations, and a history of weathering economic storms. Finally, we need to control our emotions. Fear and greed are powerful forces in the market, often leading to poor decision-making. By staying disciplined, sticking to our investment plan, and tuning out the noise, we can weather the storm and come out stronger on the other side. Remember, every crash is a buying opportunity for those who are prepared.